This house that you guys are looking at right behind me is a foreclosure house. It's 4-bedroom, 2-bathroom, and it's listed for only $76,700. This house originally was listed by the bank on August 15th for $125,000, has had several price cuts, and now they're down to $76,700. And the property tax bill here is only $1,300 a year, which actually ended up dropping over the past couple of years due to the poor condition of the home. So, a couple things to be learned from this. Number one, a lot of people say, oh, there's nothing happening with the market. There's no foreclosures. Okay, well, here's an example of one right here, guys. $76,000 for this house. Probably needs a full renovation, probably needs a lot of different things, but it's available in a neighborhood where you're typically going to pay at least $170,000 for a house where we're at right now in Macon, Georgia. Some people just have to be Mr. Right, and I saw somebody say something about my last video or a different video that, oh, property taxes do go down, Michael. Oh yeah, here you go. Sometimes they do go down, guys. Before, you know, they were paying about $1,500 a year. Now it's $1,300 a year. So $200 a year, whoopity-doo. Did it go down? Yes. Is that very common? No. Look how many times it went up versus how many times it went down. So that's something that people just need to understand. Like, listen, guys, foreclosures are out there. They're happening. You know, we don't see them in very many places like in Miami where I live, or all these places we were walking in the Bay Area. They're not that common, but they're out there. And one thing that's been great about traveling across the entire country like this is you see how different neighborhoods look. You see how different people live. You see what kind of value you can get for the money in different neighborhoods. And the differences are kind of striking, you know? Like where we're walking at right here in Macon, Georgia, median home price is only like $171,000 a year. And I'll get to that later on in the video like I have been. But first, I want to talk to you guys about how there is yet another low down payment mortgage program coming out from Chase Bank that is designed to get people into homes with only 3% down. It's not a 1% down mortgage, but it is a 3% down mortgage, which is basically like an FHA loan in terms of the amount of money that you need to put down to get into the house. And I'm afraid that a lot of people who are going for loan products like this are going to end up just like that foreclosure right back there because they don't really understand what they're getting themselves into. But let's take a look at what they're offering here from Chase now. So it's a 3% down loan, and typically for a conventional loan, the lowest you can go is 5% down. So it's not a conventional loan, and FHA is usually 3.5% down. So it's actually a little bit less than FHA. And of course, it comes with some caveats, and not everybody will qualify for this, but it's aimed at the low-income borrower that's having a hard time getting into a home right now, which is the most vulnerable type of person to actually buy a house in this environment. So the caveats are, number one, it has to be your primary residence, and you cannot do a cash out refinance with this loan, meaning that later on, I mean, you can refinance, but you can't do a cash out refinance. And the difference is you extract all the available equity that they will let you take up to 20%, and you can take that cash and do whatever you want with it. So say you have $100,000 of equity in your house, and in order to keep 20% equity, you need to have $50,000 in equity to stay at 20%. Well, in that case, then you could do a cash out refinance and take 50 grand off the table and have your new loan with only $50,000 in equity in your house. But in this situation, you wouldn't be allowed to do that, which is actually probably a good thing. And you have to take Chase's educational course on purchasing a home. So it seems like a lot of these basically first-time home buyer programs are aimed at getting people that don't have a lot of money into buying a house. On top of that, they want you to qualify for the Chase Grant, which can apply either $2,500 or $5,000 toward the Dream Maker loan down payment. That's the name of the loan. It's called Dream Maker. It should be more like the Nightmare Starter, but instead it's the Dream Maker. It says that keep in mind the funds are first applied toward lowering your interest rate, and then they get applied to fees, and finally any remaining funds can be applied towards your down payment. And regardless, the grant can save you even more money on buying your home, which is true. They're basically giving you free money. a lot like these other programs are doing with Rocket Mortgage, United Wholesale, and Zillow. In order to be eligible for this loan, they have the same eligibility requirements as well. You cannot have an annual income that exceeds 80% of your area's median income. And that means if you're looking to buy a home in a neighborhood where the median income is $80,000, you can't earn more than $64,000 per year in order to be eligible. And you have to have a minimum credit score of 620, which is also not that great. So it's basically a carbon copy of the Rocket Mortgage setup. The only difference is you have to put down 3% instead of just 1%. Now let me show you some of the houses here too, where just facing the forest on the other side. But in all reality, it's all kind of the same thing. You're not putting a whole lot of skin in the game, and it's designed for people that don't make as much money, below the median income in the area. It has to be only 80% or less. So those are the people who are going to be applying for this and getting these type of loans. And I've stated numerous times in previous videos of why that's a problem, because people like that, if they don't even have the money to be able to give a substantial down payment on the house, how are they going to handle it when the water heater breaks, or the furnace goes out, or the roof needs to be completely replaced, or a repair needs to be done, or what about one of these big trees right here falls down and needs to be removed? There's a lot of expenses that come up as a homeowner that people like that don't think about because they've never owned a home, and they just don't have the experience, guys. That's all. That's all it is. They just don't have the experience, and you just don't know. And that's why I make these videos, so people do know. And some people take it the wrong way. You can interpret these videos however you want. Some people think that it's, fear mongering, but in reality, and to me, I'm trying to educate you. I'm trying to help you out there understand what type of risks you're up against in this environment as somebody who's seen it all play out before during the 2008 housing market crash. And by the way, got my Hollywood Metallica t-shirt on again. Nice day to be wearing that out here. It's like 61 degrees, partly cloudy. Beautiful day, actually. And this neighborhood's actually not so bad. It kind of changes a little bit. You saw by the foreclosure, it looks a little bit iffy, but then you come down over here and it's pretty nice. And this is also going to be the last video you guys are going to see from me until we get back to Florida. And from here, we're heading somewhere over by St. Augustine or the Palm Coast, and I'll explain why when I make those videos for you and you see that. Last stop before my home state. Can't wait to get back to Florida. And the crazy thing is, and what should be another red flag for people when they see these things happening, is how many of these programs are popping up. We have already seen Zillow. We've seen United Wholesale Mortgage. We've seen Rocket Mortgage. We've seen now Chase jump on this bandwagon. Bank of America has a similar program for minorities. And now, one of my viewers, Richard, just sent me this email from Nestment. I've never heard of this company, but they're offering now a new type of loan for people who want to buy multifamily. So this is aimed at first-time real estate investors, or even experienced real estate investors, really anybody that wants to buy a multifamily property. And this is a big deal because look at this. The down payment for a multifamily now can be as low as 5% down. In the past, it was between 15 to 25% down. That is a massive difference. A while ago, when I bought a duplex, we had to put down 25% down in order to buy that property. There's no way you could buy it without putting less down. It was just impossible back then. And that was like back in 2018, something like that. Okay, well now they have this new program from Nestment, and they're changing the rules with Fannie Mae, and they're basically allowing people to buy these properties now with only 5% down. And the reason that they're doing this is a couple of things. Number one, the lending business is going out of business because they're not writing enough loans to stay in business. So this is probably the government throwing them a bone, saying, here you go, we'll change these guidelines for now, so hopefully you guys can get more people through the door. And the other thing is, it's proof, once again, that they're lying, guys. Just like I've told you in my previous videos here, that all these guys, the lenders, the real estate agents, everybody's saying that things are great and it's still a great time to buy. If that's the case, why do they have to come out with these programs that basically have to convince people to buy? Because no one had to convince anybody to buy a multifamily property 2 years ago, or even give you an opportunity to do so with only 5% down. But now all of a sudden that's something that's needed? Why is that? Oh, that's right, because no one's buying them. And it even says right here, look what it says, guys. This is starting on November 18th, okay? So this is coming up in about a month from now. And this applies to 2, 3, and 4 unit homes, just 5% down. And it creates an exciting opportunity for multi-property investment and combining ownership perks and affordability. Industry experts are praising this move for the potential income generating possibilities. Oh my God. Guys, if you find something, please send it to me. If you are an experienced investor or anybody running the numbers on these properties, if you find a multifamily property that you can only put 5% down on right now at a 7.5% interest rate that will still cash flow, please send it to me. Send me an email. My email's in the about section because I would just love to see that right now. Because you know what? I would almost guarantee you that opportunity doesn't exist. And also may compete with other programs and open new markets for prospective homeowners. Oh my God, you guys are doing us all such a huge favor. And of course I have information here to back up why they're doing this, guys, because at the same time, we are now starting to see reports like this, where home sales for 2023 are now on track to be the lowest year of home sales since the housing crash back in 2008. No joke, this is for real. And the numbers are down substantially. Take a look at this graph. We can see that 2023 so far has been absolutely abysmal, and it's almost over in terms of home sales. It's no wonder you're seeing programs like this come out begging people to buy. You know, they're almost giving it away for free when it's 1% down or 3% down, and even giving you an extra $5,000 as a bonus to buy something. And like I've said before, when they give you these opportunities, it all might look great for you, but it's all disguised that way to make it look like a great opportunity, because you're going to be the one left holding the bag when things really turn around. And you'll see what I mean in a little bit here when we talk about Macon, Georgia. Now, obviously, the reason why these home sales are down is because interest rates are too high at these prices. We all know that. That's not a big shocker. But if existing home sales end up below $4 million in 2023, that means this is going to be the worst year on record since 1995. I'll bet you some of the people watching my channel right now weren't even born yet. And guess what, guys? If you think that, oh, well, that's not a big deal, things will bounce back, we're not going to have any consequences from that, Michael. Well, think again, because this is actually going to send ripples throughout the rest of the economy in the form of things like helping push the rent up, because more people are going to turn to renting rather than buying. Although the one good thing about the rental market right now is we are getting 1 million new units delivered this year in 2023. So that is fabulous news as a renter, but we're going to need those units to absorb the extra demand for rentals coming in the future. And guess what this is also going to do? It's going to keep inflation higher. They're always running the inflation numbers in the reports based on what's going on with the rentals. And oh, oops, well, inflation's going back up, so we need to keep raising rates. Ugh. What's that going to do? And also, when home sales slow down, so do commissions. So people that work in the industry don't make as much money, so they don't have as much money to spend. Since people aren't buying as many homes, you're not seeing new home buyers go out and buying things like appliances and furniture. And you know, it also is not a really good incentive for builders to continue building either if nobody's buying homes. So there's all sorts of consequences that can come from just not having enough real estate transactions. It definitely has its effect on the economy that most people probably wouldn't think about. And to give you guys an example real quick of what this might look like, there's a woman in Kansas, right? And her mother passed away and she inherited the house and needed to sell the property. And that's another thing real quick, going on a quick tangent that I want to mention, is a lot of people think, oh, people are going to hang on to these houses forever. Well, no, they're not, guys, because people die, people pass away, people inherit the houses, and usually 75% of the time they sell them. But anyhow, they don't just hang on to them and turn them into rentals and become some big real estate mogul, okay? A lot of people think that's how this is going to go down. It's not. So you have this woman here, her mother passed away, and it was a ranch-style home, must have been a nice one, in Kansas, and they tried selling it in October of 2022, so already a year ago, for $650,000. And now, fast forward to today, the house is under contract for only $400,000, and she's giving the home buyer a $7,000 credit towards their closing costs. So they took a massive $257,000 haircut off of this property, thinking that they were going to cash in on it, you know, big time last year and charge too much. And that's what you're going to see happen with all of these listings that people had on the market that they thought they were just going to ask the moon for, and people were just going to bid over asking and pay whatever they want. Those days are over. And this story is proof of that. The daughter even said here that they expected the house to sell right away, but instead they ended up having to keep dropping their price. And what does this all boil down to? Affordability. How many people living in the middle of Kansas can afford a house at $685 grand? Probably not that many, guys. I'd be willing to bet probably maybe only a couple thousand people. And even the home builders that have been giving the deals of the lifetime for a brand new construction build anyways over the past couple of years are starting to get hit too. You know, their sales have been slowing down pretty substantially going into the second half of this year now that interest rates just continue to tick up. You know, everybody kept saying they were going to go down by the end of this year. It's going to be down. It's going to be 5%, 5.5%. Well, now we're sitting at close to 8% and people are walking away. And then when they talk to home buyers, they're like, yeah, you know, we've been looking to buy a house for a year and inventory is really tight, you know, and we're just seeing that the longer we wait, the higher interest rates go and the higher prices go, and it's getting harder and harder. Like I told you in a previous video, guys, what is the rush? If you think that situation is going to be permanent, it's not. Nothing in the housing market is ever permanent, okay? We're in a transitionary period right now, and we have this perfect storm set of circumstances with low inventory, high prices, and high interest rates that can make people feel completely stuck and give you the FOMO mentality that you're never going to be able to get into a home. But rest assured, that's going to change. It's not going to remain like this forever because it never has in the past and it will not in the future. So we're in Macon, Georgia. Let's talk a little bit about this area and see what's going on here. Well, check this out, guys. The median home price here in Macon is only $171,000, which is still very affordable. That is far below the median average in the country of about $400,000. Yet, guess what? This is the first market that we have visited on this road trip that is actually down double digits year over year. Home prices here are down almost 12% year over year. That is a significant drop. And, you know, a lot of people like to say, oh, well, there's no housing crash happening. So you're telling me that a 12% drop in just 1 year is not a housing crash? Because if it's not, guys, I don't know what is. Even during the 2008 housing market crash, home prices were only going down by a few percentage points per year. This is 12% in 1 year. When you look at markets like this, it's worse than the 2008 housing crash. But I think what gives people this idea is it's not happening on a nationwide scale yet. And it might not. You know, there might be markets that end up being resilient through all of this for whatever reason. Their local economy just continues to thrive. People have a lot of money there. You know, there's just not a lot of job losses in that industry throughout this recession, which helps keep the market going and keep things propped up. You know, it keeps the transaction flow moving. So people look at their market and say, well, I don't see this happening here, so this guy must be full of it. Well, I'm not. In fact, I just traveled all across the country to show you guys all different walks of life, all different housing markets, and this one here by far is the weakest one that we have seen so far. 12% down year over year. Home transactions are down 12% year over year as well. Even with prices this low, it's still affecting people's ability to buy. And once again, kind of similarly to Birmingham, even at these rates and prices, it's still affordable for the locals, guys, but yet prices are falling off a cliff because the house payment as a percentage of median income here is still only 28%, which is well within the range of affordability that any lender will approve you for. They're approving people up to 44% in many cases, debt to income ratio, even higher than that for FHA loans and different government-backed loans like that, over 50%. And so at 28% debt to income ratio, that's a lender's dream. As long as you have the income, as long as you have good credit, they'll approve you on the spot. But this area is definitely in danger territory in terms of the overvaluation. 26% overvalued. That means there's still a lot more room for home prices to fall here, even though they've already fallen by 12%. And that is substantial. And guess what? This is all happening at a time when inventory is still far below where it was 6-7 years ago. In 2016, there was 1,100 homes on the market here. Fast forward to today, It's only 645. So a little bit more than half of what was available back then are the amount of homes that are listed, yet people are not buying them. And just like I asked you in the previous video, what do you guys think is going to happen when the inventory returns back to normal levels? What do you think it's going to do to prices then? Everybody keeps thinking, oh, all the buyers that have been on the sidelines, they're all going to come in and swoop in and buy all these properties up. Well, not so fast, because if people don't have the income or they don't have the money to be able to do it, it's not going to happen. Unfortunately, that looks like the direction that we're going to be headed, and that's just the correction that we need. It's just a necessary law of economics here that needs to play out. So to me, all this shows some serious cracks starting to form in the housing market, and it's just going to be a matter of time before it all starts spreading to other areas. But like I said, maybe it won't hit everywhere. Maybe there will be some areas that will remain resilient throughout an economic downturn. It happened before, it can happen again. But no matter what I say, no matter how many times I say it, there's always people that are like, hey, well, this guy doesn't know what he's talking about. Whatever, guys, you know? Say whatever you want, you know? It's a free country. I'm here saying whatever I want. But at least what I'm saying is backed by facts and data. Now, another thing that people should know is one of my viewers, Gary, he sent me an email saying that he was having trouble renewing his insurance policy in Florida. He was with USAA. Apparently, he was sent a renewal bill in the mail that somehow got overlooked because they don't send things certified like they should, especially for important documents like that. And so it went unnoticed, and his homeowner's insurance was canceled. Long story short, he had to email the CEO. He spent days on the phone, things like that, to actually get his policy reinstated. And it looks like they're not going to be writing any new policies in Florida, similarly to a lot of other insurance companies. But this scared Gary so much that he's getting ready to go without insurance, because he wrote me saying that, you know, his house is fully paid for and he was prepared to go without insurance and just post a bunch of no trespassing signs around his property and drain the swimming pool and imposing a no guest policy. So nobody can come over, nobody can have a chance to get hurt at my house, so that way nobody can sue me. So it's kind of crazy that people need to resort to things like this to start feeling safe, to start feeling like they're not going to have to worry about lawsuits from people, especially frivolous ones, to the point where people can't afford the insurance that's out there, or they're being dropped from their coverage and they're not allowed to get the coverage that they really want to get. Just a word to the wise out there, if you're looking to buy a house in Florida or you currently have USAA insurance, make sure you watch out for a cancellation notice, because you could be next on the chopping block and you might not be as lucky as Gary to get your policy reinstated. So if you enjoyed this video, make sure you subscribe to the channel, and if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.